So how are interest rates set in this country? Well, once upon a time they used to be set by the government, and the Reserve Bank of Australia used to lend money, lends money to other banks, and then those banks lend money to you. Now the Reserve Bank lends that money at a variable rate to the banks, and then the banks lend it to you at a markup, and that's how the banks make their money. Now once upon a time the Reserve Bank used to be told what to do with interest rates by the government and by public servants. But it was decided during the recession of the 90s by Paul Keating and his government that we needed to put a stop to that. What we needed to do instead was establish an independent board that would tell the Reserve Bank what to do with interest rates. And that way they took the political element out of the setting of interest rates, because the interest that the Reserve Bank collects is revenue for government. So parties would get elected and want to pay for their promises, so they would then ratchet up interest rates. It wasn't healthy for the economy and gave us the recession that we had to have. Once the Reserve Bank Board was made independent, they were told to keep inflation at 2 to 3%. Now how do they do that? Well, the ABS every month does its inflation figures, and it considers in there the price of milk, the price of bread, the price of petrol, everything, and then reports an inflationary figure. Now if inflation is taking off, the board will put the interest rate up. In turn, the banks will put their interest rate up on you, and you will have less money in your bank account. And if you have less money in your bank account, you'll do less spending. And if you do less spending, then that's going to reduce the pressure on inflation. Conversely, if the economy is stalling, the Reserve Bank will drop the interest rate. In turn, the banks will drop their interest rates to compete with each other and retain your business, and you will have more money in your bank account. And if you're like 9 out of 10 Australians who are hopeless with their money, what will you do with that money? You will spend it. And if you are spending it, what will that do to the economy? It will stimulate the economy. It's a brilliant system. It's the envy of many countries, and it's what saved us from the global financial crisis. Because when the global financial crisis hit Australia, the independent board of the Reserve Bank dropped interest rates about 4.5% in the space of 6 months. Now when the global financial crisis hit Australia, I had a multi-million-dollar property portfolio. I wasn't worried about the global financial crisis. I was like, crisis? What crisis? Interest rates hadn't been so low, and now they're even lower. It's fantastic. If you look at the historical base, and on this graph you can see that the Reserve Bank rate's the blue line and the retail rate that the banks lend is the black line. And as you can see, it's slightly higher all the time, which is a bit of a glitch there on the 1990 figure. But it's slightly higher all the time because that's how the banks make their profit. Now, if you understand this system of how the interest rates are set, you can understand all these events. So this 1990 was when we're at the height of the recession, double-digit interest rates. And that was also when the board was made independent. As soon as the board was independent, they started driving the interest rates down to stimulate the economy. And as you can see, down came the interest rates. When we got to about 95, 94, things then started to bounce and the economy started to recover. But then we got to a thing called the tech boom. And the tech boom took off in 95, and then we had the tech collapse in the late 90s. So we dropped interest rates again. So you can see during the boom and bust, interest rates have followed accordingly to stabilise the economy. What happened in 2001? September 11 terrorist attack, World Trade Center. Wall Street closed for 2 weeks. Massive global uncertainty about the markets. America invaded the Middle East, invaded Afghanistan, and not long after went into Iraq. Lots of uncertainty. What did the Reserve Bank do? Drop interest rates. And then we went into this period from 2002 to October 2008 of great prosperity in this country, and interest rates went up slightly each time as a result. But then the global financial crisis hit. When the global financial crisis hit, as you can see, the interest rates were dropped by the Reserve Bank from what was about a 6.5% base all the way down to a 2.25%, which is a drop, quite a significant drop. Then things went quiet, And then Australia bounced out of the GFC as one of the places to invest. And lots of money came into Australia, and we saw a mining boom, and we saw booms in other areas. And as you can see, the interest rate had to be put up again to slow down the economy. And then we had the end of the mining boom and the interest rates dropping and dropping. So you can see there now we're at record low interest rates. We're at 1.5%. Interest rates have never been lower in this country, and they're going to stay low for quite a while. This presents a massive opportunity for savvy property investors because you can get into property, you can load up, fix your rate if you like for 5 years, hold the properties for 4 years, and then assess when you've got a year to go before you come off your fixed rate. You can assess it then and decide whether you want to hang on to them or sell them.